Welcome back to the show. It is 6:33 on this Friday Eve edition of the Labor Day weekend show, right? I mean, Memorial Day. Did I say Labor Day? Right, Memorial Day. All I know is I got vacation head, even though I have to work on Monday. Michael Lebowitz, CFA, joining us this morning. Mike's also ready for Labor Day. He's already come down with his... you've already come down with your spring cold and everything.
Yep, ready to go.
Yeah, Mike's up in Maryland where they actually have seasons. So they actually, things like bloom up there. But actually, we have all the pollen stuff down here going right now. Everybody I know is walking around with a nasal drip at the moment. So, all right. Well, Mike, futures are pointing down fairly decently this morning, down 22 on the S&P, and the Nasdaq's down about 83. Dow's down a little over 200 this morning. They didn't really like what the Fed said yesterday in their minutes. The markets have really been kind of betting on the fact that the Fed was going to kind of fold to President Trump and look at cutting rates sooner than later. In fact, if you look at the Fed funds prediction of future Fed funds rate, they're pricing in a cut by the end of this year. But at least from my initial read of the minutes yesterday, that really doesn't seem to be such a likely event. What did you take out of it yesterday?
Yeah, they seem to have taken what we call a more hawkish stance, meaning that they're less likely to lower rates over the coming, call it 3 to 6, 9 months. Mm-hmm. And like you said, the market's priced in for lower rates. Specifically, they think the Fed will cut by the end of the year. So we talked about it, Lance, yesterday afternoon, and I was surprised that the market didn't really react negatively. It was down a few points from where it was before they released the minutes. But it was, market didn't seem scared. This morning, it seems to have digested what the Fed has really said. And it's, like you said, markedly lower.
Yep. But again, what I found interesting, particularly in the notes yesterday, is that two things in particular. Now, let me be clear. These were the minutes of the last meeting that they had last month, right? So, sorry.
Can I stop you? You for a minute?
Yeah.
They are called the transcripts.
Right.
Now, what me and you know as transcripts are when someone takes notes at a meeting and then publishes them.
Correct.
And those notes usually are verbatim.
Right.
These quote-unquote transcripts are revised and modified and updated.
Right. Yeah, so, this is not what they actually said at the meeting.
Right. This is what they wish they would have said 3 weeks later.
Exactly. No, and I think that's I think that's a brilliant point because I've said this before. Everybody watches the Fed. If you're not in the markets, I understand you probably don't know, who the Fed is. And I find what's totally fascinating about this when, I was in the markets in the 80s and the 90s and even really in early 2000, if you ask somebody on the street who the chairman of the Federal Reserve was, they go, what's the Federal Reserve? Right? I mean, they were behind the scenes. Nobody knew who Alan Greenspan was really unless you were in the financial markets. But the average guy on the street had no idea who the Federal Reserve Chairman was. I mean, it's just most people barely know who the president is, much less who the Federal Reserve Chairman is. Now, this guy is probably one of the most prominent figures. Everybody knows who he is. Everybody watches what he says. Whether you're in the financial markets or not, you've probably paid attention to what's going on with the Fed because it's so public and so televised now. And the point about this is if the Fed ever actually came out and said what they actually said in the meeting, which is, hey, man, we're getting really close to a recession. This corporate debt issue is a much bigger issue than, and we're concerned about it. But we certainly can't tell anybody because if the Fed came out and said, hey, this corporate debt issue or the markets or there's a recession right around the corner that we see, everybody would panic and we would be in a recession immediately. So they have to really carefully tailor what they say because the markets hang on every word the Fed says.
Every single word. They care about adjectives, verbs. They're very careful to say the right thing, to kind of cut right down the middle. Mm-hmm. So, unfortunately, our jobs now as investors, we depend on what the Fed says because they have such an impact on the market and where people think the market's going. So we have to pay attention and we have to look for slight changes and inconsistencies. And what's interesting about the report that we got yesterday was that there was what I would say is a little something for everyone. they were wishy-washy on a lot of topics. And if you thought they were hawkish, it certainly seemed hawkish to us. But I can also see how someone may have come away from that thinking that it was dovish. Inflation, that's a great example.
Right.
They said that in the recent downtick in inflation, which is very minimal, but they said it was transitory, meaning it's going to last for a few months and go away. That's hawkish. That means they're not going to cut rates because of lower inflation if it's really not going to last that long.
Right.
Then right after that, they go on to say, however, they are concerned that inflation expectations are getting anchored at a lower rate. So now they're saying, well, we are concerned that everyone thinks inflation will be lower. So just in those two statements, you can see how someone that thinks the Fed is not going to raise rates is not going to raise rates because it's transitory.
Right.
But then someone else thinks, yeah, they're going to lower rates because they're very concerned about inflation expectations.
Right. Yeah, I know, and this is, and to your point, this is kind of like, I'm about to make a real old reference here, but, Detective Columbo, he always said, oh, and one more thing, that's kind of the whole point is that, no matter what he says, there's, oh, and one more thing, and when you start taking a look, they mention something, and they've done this recently more and more times, talking about the level of corporate debt and the issue of leveraged loans and loans that have weaker underwriting standards that could be a risk to the markets, but yet, the markets kind of just overlook that entirely as not being a real issue because, well, we don't need to worry about corporate debt blowing up because if they do, the Fed will just come and bail out the markets again.
Right. So I actually wrote an article, we published it yesterday, on corporate debt and why it does matter. But if you look at that set of statements from the Fed too on corporate debt, you can also read that both ways. Corporate debt is a problem. There's too much of it. In other words, we shouldn't lower rates because we're just incentivizing corporations to take on more debt. Mm-hmm. Then on the flip side, what you just said, Lance, is, well, corporate debt could be a problem, so we have to lower rates so that we can better support corporate debt and not let some of these companies get downgraded and or go out of business.
Yeah, and by the way, the article Mike's talking about is on the website right now at realinvestmentadvice.com, and it's an excellent read. It's called the corporate Maginot line, which, if you don't know what the Maginot line is, this was a wall. It was basically an impenetrable barrier between the French and the Germans during World War II. And it covered World War I, my apologies. And it covered a very small line that they thought that the Germans would actually cross into France. Well, Germany saw this impenetrable line and said, okay, we'll just go around it. And they just went around the wall. It's kind of like the border wall we have on the Texas border, right? We have like 54 miles of wall, and everybody just goes, oh, well, there's a wall there, can't get there. So they just go around it. But that's kind of the idea here is that, if there's one small change here, we have so much corporate debt that is right on the verge of being junk rated. There could be a very rapid increase in the amount of junk debt in the markets with just a very small downtick in credit quality.
And here's the key takeaway, Lance, that I think most investors don't understand. In the equity markets, we buy whatever we want. You can buy companies that don't make money, that have debt problems. You could buy very good companies, but most investors are not restricted from only buying good companies or only buying bad companies. In the bond market, most institutional investors, which is a large percentage of the holders of bonds, can only buy what they call investment grade paper that's rated triple B or better. So when debt goes from triple B to double B, gets downgraded, they have to sell it and someone has to buy it. And our big concern is that if enough paper gets downgraded, there's no one to buy it. Right. There is someone to buy it, but the question is, at what price will they buy it? And that price could be much lower than what we're seeing today.
Right. And the implications of that is not simply just the function of there's not a buyer. If we go back to 2007, what was the real cause of the financial crisis? The real cause of the financial crisis wasn't the subprime debt. I mean, it was a problem, right? It was $600 billion worth of subprime debt, but that wasn't the real issue. What the issue is when Lehman filed bankruptcy, there was basically nobody willing to buy anything in the markets. The credit markets literally froze up. There was, if you wanted to issue debt, you couldn't issue it. There was nobody to buy it. And basically the markets just entirely froze. And that's what really caused this massive drop between September and December was just this complete lack of liquidity in the markets. And that's the real risk here, is that if you start having this massive downgrade into junk rated territory and buyers evaporate, you're going to have very much the same thing happen again. You'll have a lack of liquidity in a market that's 4 times the size of the S&P 500, which is the bond market. But the other problem with that is that all of a sudden financing and liquidity for companies goes to zero, and you have a massive wave of corporate bankruptcies because of lack of liquidity, which in a way is actually worse than the financial crisis, because this is going to lead to millions of people losing their jobs if that occurs.
That's right. And the Fed's clearly aware of this based on what Powell has said over the last couple of weeks, based on what Kaplan from the Dallas Fed has said. So this is on their radar, and it's a concern. And we're just going to have to wait and see on how the Fed thinks they can help solve this what could be a big problem.
Exactly. All right, quick break. That article is on the website now. It's Michael Lebowitz article called The Corporate Maginot Line. It's on the website now, realinvestmentadvice.com. We'll be right back after the break for more of the Lance Roberts Show right here on The Voice of Texas.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at lancerobertshow.com.